Good morning from our global headquarters in New York. I'm Menace Graney alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Mideast uncertainties, the region on edge after the death of Hezbollah's leader. Israel bombed central Beirut, ramping up its attacks. And a port shut down. U.S. East and Gulf Coast docks brace for major disruptions amid potential worker strikes. And Fed Chair Powell is set to speak later today in a week jam-packed with jobs data. Good morning, Manus.
Danny, yeah, it's bookended by Chairman Powell. Equities are on the back foot this morning. We have had the best start to equities since 1997, 3/4 of a rush of blood. There's a push and a pull this morning in the markets. What's dragging on some of the bigger U.S. Auto stocks is, of course, the profit warnings from Europe. How does that wash up here in the United States of America? And then you have the stimulus from China. So we're juxtaposed between the two. But the bears have been solidly crushed in the first 9 months of the year. By the way, the Bloomberg poll says 60% says U.S. equities, that's where you want to be for the fourth quarter. Roll it over, have a look at the bond market, because, of course, again, on the MLive poll, 59% of our poll see two cuts coming through in this third quarter. 34% see a bigger cut than that. Yields just tick ever so slightly higher. This morning, you have that validation from the PCE on Friday. Now, we talked about stimulus pretty much every day last week in China. How does that wash up on the shores of risk in the United States of America? Again, even though it's housing stimulus and relaxation of the rules in some of the biggest cities, you are seeing the ADRs in the United States of America, again, tick higher. This is one of the biggest automakers in China, again, capitalizing, and that's been the headwind for the autos in Europe and here in the US in terms of the transition to EV. Danny.
Manus, you said something there that just keeps happening over and over, and that is the bears getting crushed. It's remarkable to think that we started September with the same old risks, that there's going to be a recession, the labor market's weakening, the seasonality is bad. Instead, we got a jumbo rate cut, we got stimulus from China, and the data hasn't been all that bad. And here we are, risk is alive again.
Risk is alive and well. The jobs report at the end of the week, 146,000 is what we're looking for. We'll have the whisper number between now and then. Risk is firmly on. Growth here in the United States of America is very solidly showing exceptionalism. The Bloomberg poll, the MLive poll, basically says you want to avoid oil, you want to avoid bonds, you want to buy U.S. equities. That is the alpha for the MLive poll for the fourth quarter.
And same thing as last week. Europe only reinforces that, right? When you have these poor earnings from the car makers, and you have Germany now, according to people familiar, set to wipe away their forecast for growth for the year.
Well, Germany has a lot of issues in the M&A game, to name but a few. Look, we'll talk about the equity markets, but there's a growing list of currency traders out there who are steering clear of the dollar. And this is amid uncertainties around the election and economic growth. Who's avoiding it? Wells Fargo, RBC, Allspring, all highlighting a cloudy outlook in the near term. Joining us now is Kamakshya Trivedi, head of global FX and rates at Goldman Sachs. So we're building up. We've got a pro-risk narrative in the equity market. The dollar's on the back foot, down for 4 weeks in a row. Is it political headwinds as well as rate headwinds that, as it were, brings the dollar to ground?
Yeah, I think it is a combination, I would say, of, rate headwinds. Clearly, the Fed has been more aggressive in terms of responding to concerns about slower growth, than its peers in other major markets. But I think really the fact that the dollar has been somewhat soggy over the past week has more to do with developments outside the U.S. You mentioned China's stimulus in your introduction. I think that's been a big, that's played a huge role. But equally, for example, the implications of Japan's election of a new LDP leader, I think that's had some hawkish implications as well. So I think it is really a combination of the pro-cyclical environment generally, a little bit of more aggressive response from the Fed, but I think more recently it's been developments outside the US that have been driving the dollar weakness.
On the point of Japan, Kamakshya, because you had said that you expect strength in the yen, but a slow one, does this new prime minister change that?
No, I think the reason why we expect a gradual appreciation in the yen that is actually slower than forward pricing or consensus expectation is both because of what's going on in the US, but also what Japan itself needs. I mean, think about it. As you just mentioned, the US economy is still doing pretty well. In fact, Q3 GDP is tracking above 3%. The yen tends not to appreciate massively if US equities are going up, if US rates are moving up as well. And so the combination that really argues for a much stronger yen in the global macro market space is not there. And then you think about Japan itself, a very strong or a very rapid appreciation in the yen could risk this fight against deflation that really Japan has been fighting for the last many years. I don't think that's in Japan's interest. I don't think the Bank of Japan is going to make that mistake by moving too fast. And so I think from both sides, I think a gradual yen appreciation is still the right view.
You would describe the US dollar exceptionalism as something which is diminishing. So it's not diminishing in the pro-cyclical risk assets here in the United States of America, but you say US exceptionalism is challenged in the dollar. What is going to be the biggest tail risk to the dollar then?
Look, I think, if you move out of the zone with really much stronger growth in China, and there's clearly been optimism around that, and much better economic activity and market prospects out of Europe, I think that is the kind of scenario where, alongside a more aggressive Fed, perhaps some downside in domestic growth in the US, that really results in the kind of tail risk of a sort of faster dollar depreciation. But that's not where we are. As I said, the US economy is still doing pretty well. It's going to be pretty hard to keep pushing the dollar down despite the kind of growth and equity market returns that you're seeing in the US on the one hand. And Europe has its own challenges. It is true that China has taken steps to mitigate some of the downside risks, and I think that is important. But by and large, I don't think we are yet in the kind of global constellation of events which constitute a very rapid dollar depreciation. So shallow dollar depreciation, still very much our mantra.
In the euro then, Kamakshya, is it fair to say that expectations of cuts given economic weakness, matter more, at least at this point, than the do whatever it takes Draghi-esque moment in China?
Yeah, I think when you look at the euro area, I think it's the fact that the data has been slowing. Inflation has come down, pretty rapidly as well. And I think the ECB is not that far off from, going into a more aggressive sequential rate cutting path. We expect that to commence from October itself. So I think that, I really don't think the ECB is that far behind. I think some of the euro's strength recently reflects perhaps the better impulse from China and the fact that the policymakers in the euro area have been somewhat more hawkish relative to the front-footed response we've seen in the US, but that's going to change.
And is that what holds the euro? I mean, the euro up here at around 110, 111, this kind of zone. Is that what gives it a little bit more relative ballast to the Fed, to the dollar?
I think that's exactly right. I think it's the fact that ultimately we see ECB policy catching down to kind of where the Fed is, but also the fact that on the US side of things still look pretty solid. Activity growth is solid. We are expecting solid payroll growth today, slightly above the consensus number. If you see that play out, if you see the kind of reassuring data we've had on things like jobless claims over the past few weeks show up also in the payrolls report, it's going to be hard to keep putting the dollar on the back foot.
So, Kamakshya, if I do want to express somehow the renewed optimism around China, if I can't do it in the euro, can I do it in the renminbi? How do I show this moment where Chinese officials clearly have more in the pipe to help the economy?
You're absolutely right. I think there is something distinct about this bout of Chinese stimulus. It seems more coordinated. There are more measures in the pipeline. It seems to have more buy-in from the highest echelons of the policymaking establishment. it also seems pretty directly aimed at putting a floor in the equity market. So I think that's the most direct way I think you're supposed to express that renewed China optimism. I don't think CNY is the place to do it. I think they don't particularly want to, much stronger, more aggressive appreciation of the renminbi. But there are other China-exposed currencies, places like the Aussie dollar that could, benefit in the short term. Across the EM world, places like the Chilean peso, the Korean won, even the South African rand, I think have been benefiting from this broader cyclical upswing.
Okay, Kamakshya, really appreciate your time this morning. Thank you for joining us. That is Kamakshya Trivedi of Goldman Sachs. Manis, let's get to some of the other top stories now trending on your terminal this morning. Volkswagen has posted its second profit warning in 3 months. Stellantis has also slashed its outlook for the year. VW is now staring down its fourth annual sales decline in just 5 years. At the same time, the Stellantis CEO, Carlos Tavares, has come under intense pressure over the carmaker's sliding sales.
Amid the slump in autos, Germany's government is set to abandon any hopes of achieving growth this year. That's according to people familiar with the matter. Officials in Berlin are set to cut their forecast for growth in 2024 to stagnation at best, representing another lost year for Germany.
And California Governor Gavin Newsom has vetoed the AI safety bill. If passed, it would have been among the first pieces of legislation to hold AI developers accountable for any severe harm caused by their tech. Scott Wiener, the Democratic senator from California, who introed the bill, called the veto a, quote, setback for everyone who believes in oversight of massive corporations.
Coming up, Israel bombs central Beirut as it steps up its airstrikes following the killing of the leader of Hezbollah. More on the story next.
And later in this hour, we're going to be catching up with RBC's Lori Calvasina on the further upside in American equity. This is Bloomberg. It's your Bloomberg Brief. Danny Berger and Manis Cranny in New York. Israel has bombed central Beirut for the first time in almost a year of conflicts with Hezbollah. This comes as Israeli media hails the dawn of what they're describing as a new Middle East after the killing of their leader. The latest from Iran saying that it won't send forces to Lebanon to fight Israel. Joining us now is Bloomberg's Jomana Bersecci. Jomana, the focus squarely on Iran, what their next move will be after the killing of Nasrallah.
Yeah.
How do these lines from Iran play into what we can expect from the region?
Yeah, so those fresh lines that you're referring to are coming from a spokesperson from the foreign ministry saying that Iran will not send forces to Lebanon to fight Israel. And this is a quote, the nations of the region, including those in Lebanon and Palestine, possess the necessary capabilities and strength to defend themselves against Israeli aggression. Now, why are these comments key? Because one of the key questions people were asking after the killing of Hassan Nasrallah on Friday was how would Iran respond to this? Iran, obviously a key backer of Hezbollah, has been a key provider of military and funding and training support throughout the last 3 decades, even to the extent that many of Hassan Nasrallah's supporters, detractors within Lebanon, I should say, criticized Nasrallah for handing the keys of Lebanon's sovereignty into the Iranian orbit. And so the fact that you could see the killing of such an important figurehead in the region and to the so-called axis of resistance, the crown jewel of Iran's assets within the region, and yet Iran not willing to step in, is very symbolic and significant, and probably is a reflection of the Iranian regime themselves and the fact that they too are undergoing a period of questions over how far they should respond to these ongoing Israeli attacks on their assets in the region. We heard from the President Pezeshkian at the UN General Assembly last week. He was seeking a more conciliatory approach with the rest. At home, he is being subject to a lot of debate with some of those more hardliner commanders from IRGC who want to see a more forceful response to Israel. But the question is, can they afford it at this point in time? And certainly the rhetoric from them at this point appears to be one of them wanting to not get involved specifically in what's happening in Lebanon, and certainly not in a broader regional conflict at this point.
Jumana, good morning. And Hezbollah also saying that they will continue with Nasrallah's plan with precision. But then this brings the other side of the equation into question. Netanyahu is emboldened. There's a sense of emboldenment there. Will he go for a ground invasion? And if so, what would that look like? There's lots of views out there. Is that the next step?
Well, I think it's also significant the fact that the operation to take out Hassan Nasrallah was called Operation New Order. That was the Israeli code name for it, because it really just underscores how significant a figurehead Hassan Nasrallah was in the region and the potential for sea change afterwards. But what we have seen over the course of the weekend is the airstrikes have continued. We're hearing this morning of the Hamas political chief residing in South Lebanon was also one of the names that was killed in the last 24 hours. 3 Palestinian resistant fighters also killed just over the course of the last 24 hours as well. So the airstrikes are continuing. And from Israel's perspective, the new war objective that was introduced was simply about restoring security to the north. So all of this is being done to ensure that rockets will no longer be fired back into northern Israel. From this point onwards, we have to watch and see Hezbollah's response. And indeed, Hezbollah is a force that is extremely debilitated, has been debilitated in the last few weeks, not only with the taking out of Hassan Nasrallah, but you're talking about senior commanders also being killed and thousands of their operatives critically injured. The question is whether or not they have the appetite and the ability to keep fighting back.
Well, it seems like a long time ago that we talked about the G7 and the Gulf Coalition de-escalation and ceasefire plan. Let's see what comes this week. Jumana, thank you very much. Jumana Bisechi, tracking the very latest from the Middle East. Coming up on the show, a look at what else is making the headlines around the world this Monday morning. Context Matters from New York. Good morning. It's Bloomberg Brief. I'm Manus Granny, reunited with Danny Berger back in New York. Not for long.
I'm sticking around.
Yeah, but you're off again today, aren't you?
Going to the ports, New Jersey, New York, same thing.
She gets the glam. Let's check in on the front pages. This is what we've got for you. Making headlines around the world. Politics front and centre. The New York Times leads with the far right winning in Austria, but may fall short of forming a government. The Freedom Party won the country's parliamentary election on Sunday, but mainstream opposition parties have said they'll form a coalition. The vote is the latest landmark in the rise of nationalist, anti-immigrant and pro-Russian forces across Europe.
Next up, the FT has this on their front page, that Japan's incoming Prime Minister, Shigeru Ishiba, calls for a snap October election. Shares are sinking across Japan, nearly 5%. The election is set for October 27th. So the expected winner of the contest is one that has called for less accommodative policy from Japan, hence the reaction there.
Yeah, a little bit of whipsaw in dollar yen on Friday. We'll talk more about those stocks a little bit later on. Let's wind it on and talk about Bloomberg. But Chinese stocks back in a bull market. I mean, they've had a fairly tortured time. Equities have rallied after 3 major cities eased the rules on housing purchases. Now, the bid is to tackle the country's property crisis. For more on the story, let's get to Winnie Xu. She's tracking this story for us. Winnie, this is about the 3 biggest main cities in China relaxing the rules. My question to you is this, does this create a new problem, or does it put a floor under the old one in terms of housing?
Right, we're seeing this as additional support for the property market, and exactly why we're seeing property stocks in China seeing a boost today, and that contributed to this big China rally that we continue to see. So people say that this is pretty much of a epic day in the Chinese market. When you look at the numbers, we've got record turnovers in both Hong Kong and China stocks, and it's not just the amount but also the speed of it. We got to 1 trillion yuan of turnover in just the very first 35 minutes. So with that, you saw the onshore benchmark CSI 300 hitting its best day in 16 days. So in 16 years. So a lot of these momentum is really building up. And with that news you mentioned about how we've got more policies to support or to ease the home buying curbs, that's actually just adding fuel to this rally.
And as you mentioned, okay, this huge rally, the hedges essentially evaporate. Winnie, how do you judge whether we've gotten complacent now or whether this is a sustainable rally on measures to come in the pipeline?
Right, that's a great question. I think that's something that remains a question mark in a lot of traders' mind. A lot of people, including Goldman Sachs, actually said that right now we see this as more of a market of a trade instead of a re-rating. There is still potential for a leg up when you look at how low the valuations are and how underweight global funds are on Chinese stocks. However, in order for people to really see, especially the long investors, to see the attractiveness of the market, they cite that they have to see more fiscal policies to come through to really support the property market for a turnaround, and also to see some more confidence to come back. So far, while we're seeing a lot of investors making some rotations within their Chinese funds, whether it's to trim some of the utility stocks or some of the industrial stocks and rotate into growth stocks. We have not really heard much about how investors are adding too much China exposures to their regional funds yet.
Winnie, thank you so much. That is Bloomberg's Winnie Xu in Singapore. Coming up, we're going to catch up with Lori Calvasina on what, you guessed it, the equity market rally in China and how much further it has to go. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manish Krani. Let's set your agenda.
Middle East uncertainties, the region on edge after the death of Hezbollah's leader. Israel bombs central Beirut. Iran says it won't send forces to Lebanon to fight Israel. Port shut down. U.S. East and Gulf Coast docks brace for major disruptions amid potential worker strikes. And Fed Chair Powell set to speak later today in a week jam-packed with jobs data. Powell gets to bookend the week. There you go, Danny.
Lucky for us to dictate risk direction in this market, because we don't have a lot of it at this moment. S&P 500 futures a little changed. We are headed higher on the month. Remarkable in a month that started with recession fears and concerns over the labor market and poor seasonality. Who cares about seasonality? Clearly, it didn't matter for this market. 10-year yields, they're up about 2 basis points. A decent week for sovereign bonds last week. Again, it's all that jobs data that's going to matter this week. And Powell, the real action perhaps is happening in Asia. CSI 300 ends up nearly 8.5% on, as Deutsche Bank calls it, the whatever it takes Draghi moment for China with more stimulus. And Japanese equities, Manis, you'll see that in a moment at the bottom of your screen, falling nearly 5%. That's after a new prime minister likely to come in. That's the S&P 500.
It's a thing of joy.
It's a thing of joy. But here we go, Manis. Here, this is the perfect risk picture. Japan is down, but look at equities continuing to fight back despite just these moments of dourness.
Yeah, I mean, this is the best. What the title chart that we have is the best 9 months since 1997 for U.S. equities. And just on that China story, you've got Lombard Odier saying, don't be fooled. They are exiting. They exited everything in China over a year ago, and they went all in on, guess what, U.S. equities, and that paid them handsome dividends. We've done the M Live blog have done their survey going into the fourth quarter. 60% say buy U.S. stocks, buy exceptionalism.
Isn't this the story for global equities? That everybody wants to get bullish some other region, and we're living with the scars of what happens to the bears. The bears keep getting punished. So even when you have this huge rally in Chinese equities, this big support, you get someone like a Lombard Odier that's like, we've been burnt before. We've seen this movie play out. We're not willing to do it again.
And I've had many an asset manager come and sit and say, actually, quite frankly, we can live without China to give us any alpha in our returns. So I think that's the sentiment out there.
Well, maybe it helps that the S&P is up 20% this year. RBC's Lori Calvasina sees more upside into next year. She writes, quote, our most generous stress test for 2024 continues to suggest valuations are full for 2024, but that there are reasons to be optimistic about further upside for the S&P 500 in 2025. Pleased to say that Lori joins us now. Lori, thanks so much for joining this morning.
Thanks for having me.
I want to know not just about the upside for the entirety of the S&P 500, but whether it's a tide that's going to be lifting things like value too, or whether it's upside that's just continually dominated by growth stocks?
So I think it's a great question. Look, I think the answer is you have to have both, right? You can't have the growth mega cap cohort of the market misbehaving too much and still expect the S&P to go up just by the math. But I do think we're at a point, right, where valuations are pretty rich still on that part of the market. We've come down from, like, I think I captured the top 10 names in the S&P at one point were trading around 32 times on a median basis on forward PE, and now they're a whopping 27 times. So they're down, but still pretty rich. Rest of market's been trading around 18 times, so it's above its average of like 15, 16, but it can easily go like to 2021. So I think we're still sort of in that period, right, where the rest of the market valuations are catching up. But I do think it's tricky, right? Because if you look at the Mag 7, they're not ceding earnings growth superiority to the rest of the S&P. They're decelerating pretty markedly into the mid-teens next year. Rest of market is moving into kind of the low teens. Like you look at like 15 on the Mag 7 versus like 13 on rest of market. So the gap is closing, right? But it's not decisive. And I think that's why we keep having all these head fakes. We keep going back and forth. And it's not that much fun, right? It's really pretty frustrating for a lot of folks.
I like the way you presented there, which is the head fakes, from growth to value. In terms of investor sentiment, you say it's flirting with a danger zone. Just expand on that. What is danger zone? Because we're giddy with these highs.
Yeah, so look, it's not the worst sentiment readings I've ever seen, right? But they're not great. So if you look at the AAII net bullishness, and that comes out every week, we get it, I believe, on Thursday mornings. And that's the one standard deviation mark above the long-term average, and that's going back to the 80s, is around 22%. And when you're above 22% on the 4-week average, you're typically flat over the next 3 months. Now, you're still up over the next 12. If you go up to a 2 standard deviation event, that's when the market tends to be a hold your nose and sell over the next 12 months. So we're not close to that 2, but we've been hovering right below.
It's not stinky.
It's not stinky, but we've been hovering right below the 1. And the problem with the 1, right, when you're around like the low 20s on net bullishness, and we hit it briefly on the 4-week average in mid-July, and we've been kind of hovering, in that like 20 plus, mark.
Yep.
If you go back the last few years, that has often marked the beginning of a short-term pullback in the equity market. So we're getting up on the end of the year. Everyone's like, debating where we're going to end up on December 31st. People are picking on strategists, for their price targets. I've been doing this a long time.
This sounds like from a personal experience that you're feeling picked on.
You've been there.
24 years in equity strategy. Okay, I've seen this, heard this song before. But the reality is that we are getting to a point, right, where we're not necessarily able to absorb a lot of bad news. Now, we are kind of shrugging off things like the geopolitics, right? But you are seeing the TDEX move up. You're seeing the VIX move up, so it's not being entirely ignored. But it is sort of a challenging spot, I think, the next couple months. That doesn't necessarily mean we go down, but it does mean, things are maybe a little bit fragile in here.
But like you said, it's been not fun if you want to try to fight it. Not even just fighting it bearishly, but going out anywhere else.
Yeah.
Europe is a great example. We've been talking about the manufacturing woes, the car maker woes. You have China maybe restoring confidence with stimulus.
Yeah.
Is now a time where you can look outside the U.S.? Is there even a willingness to do that from people you're speaking to?
So I think there's always an interest in Europe. I'll be honest with you, like the people I talk to, China is generally a trade. I mean, I thought your comments earlier, that echoes a lot of what I hear, right? So I do think, sort of good news out of China for me as a U.S. equity strategist, that feels good for risk assets. That does feel good for broadening. Ultimately, though, for broadening, I really care about how Europe is going. And we haven't gotten such great news, such great headlines there in the last 24 hours. But generally, if you look at growth relative to value in the U.S., it tends to mimic, in terms of how we trade, U.S. relative to Europe. So Europe is kind of your perennial value trade. U.S. is kind of your perennial growth trade. And so if you're debating that rotation, it's not just about like buying financials and materials in the U.S. It is, do you have the confidence to sort of go out globally?
Look, I like what you said, which is people pick on analysts and their targets. You've been very brave with yours, and you've run in part into 2025. You say 6,500 is possible, but to get to 6,500, that is obviously a very, very soft landing and solid earnings growth.
Yes. So back in July, I did a big mid-year outlook, and I ran the numbers on all of my targets. Now, it's way too early to put out a 2025 target yet, right? But we have 5 different models. We ran the math on them, and the median on that was like 6,150. So this was back in July. You know, just sentiment models, valuation models, that kind of thing. One thing we struggled with when we were writing that piece is, what do you do to the economy? Because 0 to 2% GDP, a GDP test is one of our models, and 0 to 2% GDP, stocks are normally down. If you look at 2 to 4% GDP, that's what we ultimately baked in. That's not the consensus forecast right now, but 2 to 4% is a quite strong environment for equities. We've been seeing consensus estimates hovering at like 1.7, 1.8 for next year, and they're kind of stuck. They're not moving all that much. We're in this weird environment post-COVID where we keep underestimating GDP and having to chase our tails as a forecasting community by jacking the numbers up after we see they were stronger than we thought. That has been going on now for a number of years. If you look back, post-GFC, pre-COVID, it was the exact opposite. Numbers on GDP always started out too high and had to be ratcheted down. So I think people haven't abandoned that muscle memory yet. So that was a leap of faith I had to make, to kind of get to that kind of 6,150, 6,200 number. My valuation model right now, we did update that last week post the Fed. I ran 3 different stress tests. On my earnings of 268, which are pretty conservative, that gets you to around 6,200. If you want to take consensus earnings, which are over, kind of like 280, 350, that's where you can get to 6,500. But, I think maybe 62, that's the number we kind of keep coming up more right now.
Are people bugging you for this more than normal?
Yes. And last year, we actually, we do have the 2025 earnings number out for next year. Last year was the first time I started doing it, so early because the questions are just relentless. And, I think the reality is being on the sell side, we have to be published, right? I can't just say whatever I want.
Right.
But the reality, too, is that starting points matter, right? And, again, I've been a strategist for more than 2 decades, right? The markets have a way of doing weird things in December every year and throws off a lot of people's modeling. Pay attention to the strategist in terms of where they think the direction of travel is, what's their conviction level, how they sound. I think we place way too much emphasis on precise targets.
Okay, well, we'll continue to bug you.
Okay. Sorry, Lori.
We're happy to take the 6,200, and of course, then we have the election. That could be the biggest bump of all. Lori, thank you very much.
Thanks
Lori
for having
Calvasina, our guest this morning on The Market. Sandy and I'll take you through the rest of the stories making headlines around the world on Bloomberg this Monday morning.
This is Bloomberg Brief. You're looking live at the principal room. Coming up on Open Interest, an interview with Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and CIO. That's at 9 a.m. in New York, 2 p.m. in London.
It's Bloomberg Brief this Monday morning. I'm Manus Cranny alongside Danny Berger in New York. We've little more than a month to run until the U.S. election. It's a dead heat between Vice President Harris and former President Trump in Michigan and Wisconsin. That's according to the latest New York Times Siena polls. This comes as the Democratic candidate cuts successful fundraisers in California short to head back to Washington for an emergency response meeting on Hurricane Helene. Joining us now is Jack Fitzpatrick on the latest in the polls. So they're neck and neck in Wisconsin and Michigan. I mean, these two have been decided by less than a point in the last 6 campaigns. So this is incredibly important. Where is Harris losing ground? Because the article goes on to talk about, the poll goes on to talk about Nebraska. She's ceding ground on the economy. And this is where it's incredibly important.
Yeah, she's actually losing a bit of ground, or at least losing a bit of the national advantage across the country. It's still a national popular vote advantage for Harris over Trump typically in these polls, but there's been a narrowing over the last almost 2 months when Harris came into the race and shot ahead a bit in the national polls. But one of the other takeaways from these swing state polls is that it's a tougher go for Harris and better chances for Trump than you see typically in the national across-the-board popular vote polling. In this case, it's a 1-point lead in Michigan and a 2-point lead in Wisconsin. Those are both within the margin of error. So it's a neck-and-neck race. If you just glance at some of the polls and see who's ahead in the popular vote, and you see it tends to be a close race, but Harris is ahead, that may confuse you and lead you to believe she's got a more solid lead. This is a very, very close race that's only gotten closer over the past 6 or 7 weeks.
The political highlight of this week, Jack, might be the vice presidential debate tomorrow. How do we understand the political consequences of it?
Well, first, the rule for VP nominees in a debate is don't do anything really bad. Don't make your campaign look bad. Don't have any major flubs. So it may be that this passes without a huge effect on the race, a huge effect on the polls. Both sides might be pretty happy with that. Then again, J.D. Vance wants to go on the attack on policy. It's safe to say he'll try to hit Harris and the Biden administration on the economy. Her record on the U.S.-Mexico border, possibly go after Walz for, at times, not totally accurately describing his military service record. And Vance is the one with a little bit of a ways to go in terms of getting a better spotlight. His polling typically shows that of the four people to watch in this presidential race, his unfavorables tend to be pretty high. Walz will try to go after him, not necessarily personally, but he's going after a VP nominee who's considered one of the less likable characters in the presidential race. But both sides will try to avoid making any major mistakes, which would be the big story if that happens.
Do no harm. Jack, appreciate it. Jack Fitzpatrick of Bloomberg Government joining us from Washington. Now, elsewhere, U.S. Eastern and Gulf Coast docks are preparing for a shutdown. Workers are threatening to walk out amid stalling labor talks. The spokesman for the Port Authority of New York and New Jersey released a statement saying, "We are coordinating with partners across the supply chain to prepare for any potential impacts. We urge both sides to find common ground and keep the cargo flowing for the good of the national economy." Joining us now is Bloomberg's Brendan Murray. Brendan, what are the sticking points that the union and the employer still cannot agree on?
Well, the big one is wages. The longshoremen's union are asking for a considerably higher amount of wage increase than the employers are willing to give them. And the other big issue threatening the dock workers is automation. Ports around the world are largely automated. They're almost all automated in Asia. That's not the case in the U.S., and the unions want to keep it that way to protect their livelihoods.
Brendan, good to see you this morning. Look, what industries are going to be most impacted by this event? When we think of these container ships, what is the most important product that actually arrives on the eastern seaboard?
Well, there's a number of them, and the impact will not be obvious immediately. This will have to drag on for several days or even weeks before consumers and businesses really notice the effect. But one of the key industries you're going to want to watch is the auto industry. The auto industry, particularly European automakers, use a lot of these ports, particularly in the south. And if those parts are caught up in queues outside these ports, then you could see some effect. The cars moving themselves, cars move on separate ships than containers do. We could also see the movement of imports and exports getting disrupted. Another industry is the fresh food industry. A lot of this comes from Latin America. The eastern seaboard has a number of refrigerated warehouses, things like bananas from Central and South America come through these ports. So if refrigerated containers are not moving, some of those will get priority. But if they're not moving, food spoils, and that's going to cost companies the money, and ultimately consumers could pay for that.
Brendan, a lot of people, when they heard about the strike, 2020 came to mind, and fears of the inflation that came from a stoppage of goods traveling around the world. At what point do we need to start worrying of a repeat of that, of some sort of inflationary risk to the global economy?
It seems that the people we talk to say that this will have to go on for several weeks. The big container carriers have announced surcharges for a disruption on the East Coast and Gulf Coast, but those surcharges don't take effect until around the third week of October. So there's a bit of a grace period in there, but ultimately ships backing up in ports just bogs down the whole system. Those ships go back and forth between Europe and and South America, and some from Asia. So the whole system could get backed up, and those inflationary pressures, it was just about 4 years ago this month that we saw ships starting to line up outside of Los Angeles, and a similar thing could start to happen if those ports remain closed and containers aren't allowed to move either in or out of the country.
Well, it's certainly going to cost in dollars. What is it? Oxford Economics reckons $4.5 to $7.5 billion a week. So if this drags on, it certainly can have a big impact. Brendan, thank you very much. Brendan Murray there with the very latest on the strikes on the eastern seaboard ports. Over in Europe, you've got stocks in the automakers. They're slumping this morning. You've got Volkswagen, Stellantis cutting their profit outlook. Stellantis shares hitting their lowest level since October 2022. Oliver Crook is tracking this story. Ollie, good to see you this morning. I mean, you just think of some of the Stellantis brands here, Ram, Dodge, Jeep. This is about a company going from cash generation to cash negative. What is the headwind?
Yeah, absolutely, Manus. And it's not the only one. I mean, this has been an absolutely brutal month for the automakers, as we've been reporting. I mean, these are all the companies that have cut their outlooks just in the month of September. In fact, the graphic isn't even big enough to get them all on there. We had Aston Martin coming out today as well. And there are a couple of idiosyncratic stories attached to some of these, right? BMW has that big recall. Stellantis, as you're mentioning, they're struggling with Dodge and Jeep sales, so they're trying to gas that up by spending a little bit of money. But overall, the picture doesn't change that much, and it's a question of demand. The demand is just not there. And the slowdown in China, it's hitting all of these companies majorly, particularly the German automakers. When you look at how much they've been hit just today in this session, I mean, Stellantis is down 13%, Volkswagen down 3%, Aston Martin down, losing almost a fifth of its value today, which is really remarkable because when you switch the board and you look at the year-to-date move, there is already a huge amount of bad news priced into this sector. I mean, Stellantis has already lost 40% there. We're really coming at a key moment for the auto industry, as we've been talking about, and really investors seemingly not very forgiving about it, even if with all of this bad news already priced in.
Well, that's the thing, Oliver. Some of it is idiosyncratic, sure, but as you mentioned, it's about demand. So how do these car makers turn things around?
Yeah, absolutely. I mean, the sort of formula for at least Volkswagen, and this is something that they've been very reticent to do for a very long time because a number of union representatives sit on their board and prevents them from cutting jobs, is basically having to close factories and cut jobs to meet that new reality of demand. And when you look at Volkswagen, their net income per employee, and you look at Volkswagen here versus many of their other competitors, they're about halfway to many of these. So they make basically half as much net income as any of these other large car makers. So for Volkswagen, you know, one of the biggest car makers on the planet, this is going to be their key focus. And the good news for them is that they have some room to cut there. In terms of, you look at the number of employees they have, they are the biggest car companies in terms of the number of people they employ. They employ almost 700,000 people. They employ about 300,000 of them here in Germany. And when you look at how much money it costs to build a car in terms of labor costs in Germany, it's about 62 euros an hour for a worker. When you go over to Hungary, just over the border, not too far away, it's only 16 euros per hour. So this is going to be the key for the equation for Volkswagen. Stellantis has been cutting costs to the bone, so they have a little bit of less room to ride, but this is exactly the story that we're going to be watching in the auto sector for the coming months.
Oliver, thank you so much for taking us through it. That is Bloomberg's Oliver Crook. Okay, coming up, we're going to get you set up for your trading day. As Manus mentioned, it is a week that is book-ended and book-started. What's the equivalent of the first bookend? Anyway, bookend by Chair Powell. We're going to have that next for you on your brief. Let's get you set up for your trading day on this Monday. First off, we're going to have Carnival earnings. The cruise ship operator will report before the market open. Then we're going to get MNI, Chicago PMI at 9:45 Eastern. We'll also have Dallas Fed manufacturing activity data. That's at 10:30. And then Fed Chair Powell's remarks. Those are front and center at the NABE conference. That is just before 2 p.m., Manus.
Indeed, he's going to bookend that week today and Friday on the back of the jobs numbers. 146,000 is the number. Lori Calvasina was with us. She is conservative in her view. She says we're fully valid for this year. Next year, 6,200 on her numbers. And if you go with consensus, it's Nirvana, 6,500.
I thought one of the more interesting things she also said was if you believe there's a value rotation in the U.S., you kind of have to believe that you need to rotate into Europe, too. They're one and the same trade, even with the economic woes in the country.
Earnings still hold up very strongly in the Mag 7. Don't be too quick to pull the trigger in rotating from growth to value. Surveillance is up next.